Let's chat a little bit about what the future visibility is like with the CFO. We've got Srikanth Gopalakrishnan joining in on the show right now. Srikanth, hi, good morning. Good to have you on the show. Excellent set of numbers with, be it your AUM or for that matter, disbursements. But early in the first quarter, you had upped your AUM growth guidance to 35%. What are your expectations now with regards to second half? Would you have to up the guidance further?
So first of all, very good morning and thank you for having me on the show again. It's always a pleasure to, connect, especially after a very good set of results. We did up our guidance to about 35% plus, post the first quarter results because we were seeing very strong traction on the field. As you said, on the disbursements, our numbers are really picking up. The demand is showing up extremely well. The COVID clouds are behind us. So people are today coming back to, better incomes, which means the requirement of their credit is also getting that much more. So I think we are seeing very strong traction. If you look at year-on-year growth, we were at about 43-44%. But at this point of time, we are not looking at revisiting our guidance. We are still, going with a 35% plus growth because the base is also slightly higher as we move, quarter on quarter. We expect to be, better than our guidance, but for now, our guidance stands at 35% plus, which we are very confident of achieving, having seen the demand for the last couple of quarters on the field.
The other thing, right? Because as your, base becomes higher, sustaining that kind of growth rate would be challenging. To suffice to say that at 35%, you will plateau for a while?
So our belief is that, it's going to stay on for maybe another couple of years at least, because one is, there has also been some pent-up demand. So if you look at our growth rates in FY21 and FY22, we just grew about 14%, which is almost like a flat kind of a growth. So because we were also a little wary in terms of how the cash flows of the customers are going to stack up. But what we are seeing is, yes, our belief in this customer segment stands vindicated. They have been extremely resilient. They are back to, very strong business momentum now. Which is why, we upped our growth guidance. So I think with the pent-up demand and our ability to penetrate, for example, one of the very important metrics that we have done during this quarter is putting up 70 branches. In fact, it's an all-time high in a quarter. So each of these branches are, going to become profitable, going to become, going to contribute to the growth of the company. So I would think it's not going to plateau in the near future, but maybe over 3 to 5 years, I think this number will start graduating more in a more measured manner. But for the next couple of years, we are confident of, at least about 35% kind of a growth coming through. So typically, we have been guiding the market till FY26. Our guidance still stands.
I would imagine that the second half, because of the business you are in, will be better than first half. At least that is something we should imagine.
You are right, Nikunj. The second half is always better. Not from an NBFC perspective, the last quarter always tends to be the best. So you will definitely some kicker coming through, but it will not be, significantly different from September because typically, the September quarter tends to be, relatively as good as the fourth quarter. So you can expect some positive impact in the last quarter, but I would probably say that, it's not going to be significantly material. What will be material is the new branches that we have put in. Given that, we put 70 branches and each of these branches typically takes about 4 to 6 months for them to break even and start contributing to the growth of the company. I think we should see good momentum coming from these branches in Q4.
Right. The other thing that I wanted to talk about, Srikanth, was also your margins. Because what one has seen is they got a little impacted by that lower yield. Your borrowing costs, as I see it, decline about 10 basis points on a sequential basis. And you're also increasing leverage on your balance sheet. You mentioned this as well in the past. What's the NIM's trajectory that one can expect then going forward?
Again, this is something that we've been talking. It's also going to be gradual, given our strong yields. And, one of the points that I've been talking to, all of you, and one concern that probably, was there, on our heads is how the entire cost of funds is going to stack up. Extremely happy to say that we have been showing, benefit on the cost of funds on a quarter-on-quarter basis. But again, that is definitely going to plateau or maybe increase a little bit when some of the borrowings come up for MCLR resets and all that. But our yields are stable. If you look at, we've always been operating around the 24 to 24 quarter kind of an yield. So which means even if our borrowing cost goes up a little bit from here onwards, we're still looking at a 13-14% kind of a spread. But at some point of time, like we have, even talked to you, we would want to pass on some of these benefits of the reduced cost of funds to our borrowers. So in a steady state, and I would probably put that again at around 3 to 5 years kind of a time frame, we should be looking at a steady state spreads of about 12 to 13% and NIMs of about 14 to 15%. Today, both are probably higher by about 150 to 200 bits.
What about your asset quality? Because that's managed to hold up even well in tough times like, COVID, and has seen an improvement, so on and so forth. But what's the case going forward now? Because you are getting into higher ticket sizes as well. You think you'll be able to maintain your asset quality?
So firstly, I would like to just correct a fact that you said we are not actually increasing the ticket sizes for the sake of increasing ticket sizes. We have just gone back to our pre-COVID levels. So if you look at pre-COVID, we were at about 3.5 lakhs. But during COVID, being a conservative company, very conscious strategy to lower our LTVs, lower the debt burden ratios, and also be a lot more conservative in our estimation of the customers' incomes. We actually brought down the ticket sizes all the way about to 2.5 lakhs. Today, we have just gone back there. So we really don't see any asset quality issues coming on account of the ticket size increase. The second point is, like I said a little while back, I think we really stand vindicated in our belief about the resilience of this borrower segment. So we have always been saying that this is a borrower segment that does not get significantly impacted by macro up cycles or down cycles, or even if they get impacted, they're probably last to get impacted and the first to bounce back. And that is something that we're actually seeing. In fact, if you just go back about 2-3 quarters, when the entire new norms of NPA recognition as per the IRAC norms were getting implemented, we had sort of guided the market that the difference between our 90 plus, purely from a DPD perspective, and the revised norms will be 75 to 100 basis points. But what we are actually seeing, it's only about 30 basis points. While again, we are not revising the guidance, we'll have to still see a little more time. But we are definitely very confident about the asset quality, to sort of hold around the 1.5% levels, and our credit cost to stay at around 75 to 80 basis points, which is something that, any NBFC business should be prepared for. And given our yields and NIMs that we are talking about, we are extremely comfortable with those kind of numbers. So at this point, absolutely no alarms. The execution excellence is actually getting reflected in the asset quality. In fact, 3 parameters that we actually look at, quality, profitability, and growth in the same order. We will continue to look at it in the same manner. So never are we going to put growth or profitability over quality. So quality will always remain on top for 5-star.
I have to talk about the foreign ownership as well in your business, which stands at about 50% stake. There's been a recent PE exit as well, 8.5% stake. Do you expect more such exits?
I was hoping at least this question will not come in this interview, given the stellar set of results that we have delivered. But yeah, see, that's something like what we have been, talking to you. PEs have their, time horizon. They will have to, keep selling at points of time. What we again say is that, and like how the 8.5% block deal happened, we will definitely ensure that it happens in a very coordinated manner. The good part is nobody is in a tearing hurry to sell. Even if you look at the last 8.5% deal, Matrix Partners that came in about 8 years back, they're still continuing to be shareholders on the cap table of the company. So nobody is in a tearing hurry to sell. But yes, we will see, some blocks coming at points of time. Hopefully it will be, more distanced rather than, coming at quicker intervals. And given that people are also seeing the compounding benefit accruing to them, we are hopeful that they'll stay on for a little more time. But we believe that, there are good backers for us. In fact, if you look at our the 8.5% sale that happened, very strong names like HDFC Mutual Fund and all picked up a big part of the stake. So today there are backers who are definitely confident about the business model of the company. So we don't really see any impact coming through, even if there are going to be blocks that will come in. Blocks will come in, but it will be ensured that it happens in a very coordinated manner so that both the buyers and the sellers don't stand to lose.
What about Sequoia? And I'm purely asking this specific name here because Sequoia is a compulsion because they're unwinding their book and they're a large investor. So I may like the business, but if I have a redemption happening back home and if my schemes have an issue, I may be able to sell it. And that is an overhang which everybody talks about. Sequoia, and when will they exit and what will happen to their stake?
So Nicholas, I think my answer still stands what I gave you last time. You're right to some extent. Sequoia had invested in the company through multiple funds, through their Asian funds and also their US funds. The stress, what they probably saw was in the US funds, and I'm happy to say that a couple of the US funds which had about 1.5% or close to 2% stake have completely sold off their stake. So today we are not looking at pressure coming in from the Asian funds or the Indian funds of Sequoia. So the bigger overhang that probably was there because of the internal pressures of Sequoia have largely settled. So I think I would probably put Sequoia today in a bucket which is similar to any of the other PEs. So we are not seeing any internal stress of Sequoia potentially impacting their ability to hold or them offloading the shares in the market. So we're not unduly worried about it. The one or two names that were there, the funds which were US based, they have completely sold and exited. So I think from that perspective, the overhang is largely off our back.
Star, when will it become 7-star? For 7-star, you'll have to grow at 40%. For 7-star, you'll have to up your guidance. So when will we get 7-star numbers from 5-star?
So I don't know what the 7-star numbers that you're talking about, but our belief, like I said, is that we want to be one of the market leaders in this segment in lending to small business loans. We are guiding the market for a 35% kind of a CAGR for the next 3 years at least, and thereafter it will have to start graduating. We are also hearing regulators being very happy about the business model of the company, but at the end of the day, there are other murmurs also happening in the economy. In terms of unsecured loans picking up and all that. So I think we will have to sort of balance the interests of the market, the shareholders, and the other stakeholders like regulator. But at this moment, Nikunj, we are extremely confident. The business model is stacking up very well. Demand is completely back. Asset quality is holding up well. In fact, one of the metrics that I'm sure you would have looked at is not just in terms of the NPA numbers, in terms of the DPD numbers. If you look at a 30+ portfolio, that has dropped sequentially by about 110 basis points. So we are at about 8.6%. The current portfolio is at an all-time high of about 86.5%. We are expecting this number to touch to about 90% in the next 2 to 3 quarters. So all the elements of the business are in place. I wouldn't be surprised if we surprise you by becoming a 7-star or, more than a 7-star company sooner than later.
That. And on that high note, thank you for joining us. Season's greetings, and so nice to have you back again on ET Now.
Thank you. Happy Diwali to all of you.